Will the market go up or down? Should you lock in or float? Find out this and more with Master of the Markets, hosted by Barry Habib of MBS Highway.
Hi, welcome to this week's Master of the Markets. I'm your host, Barry Habib of MBS Highway, and this is created exclusively for Mortgage News Network. And you do have an opportunity to get a free trial to MBS Highway and get this information every single day. We've gotten so many nice comments about hitting quite a few targets since people have been watching this on the stock market, on bond market, and last week hit it right on the nose on the 10-year Treasury note. We'll get to that in a little bit. Now, speaking of last week, there was some news items regarding housing, and the news was kind of mixed. Reasonable appreciation rates of just a hair under 5% on a year-over-year basis, and reasonable gains in new home sales and existing home sales, but not a market that's overheating. The pace of appreciation seems to be slowing a little bit, but this is normal, this is healthy, this is sustainable, and it looks to me that if we can keep around 5%, which I think we very well might, this will be a very good market for a long time. Now, 5% may not seem exciting on the surface, but a gain of 5%, look, someone who put 10% down on a $300,000 home, they invested $30,000. If that home went up 5%, they made a profit of $15,000. That's a 50% return on their investment. Make sure you get the word out to your customers on this. And next week is going to be a very meaningful week. It's going to be a decisive week as far as direction of interest rates go, because we're going to get news that really can move the market by way of the jobs numbers. Now, on Friday, we're going to get the official Bureau of Labor Statistics, or BLS, jobs report. This report can really sway the market's direction one way or another. Wednesday, we're going to get ADP's version, the payroll company, their version of jobs. So both of these numbers are going to have a big influence on the market. So it's going to be a quiet start to the week, but the news really heats up. And when there's a quiet start, when there's a void in news, the technical factors really take over and really dominate. Let's take a look, because as I had mentioned, we hit a couple of really good targets. You might recall this red line here. We said, hey, we look like we're going to move right up towards this line. That was last week when we were down here just above that 25-day moving average. Once we did, we said look for prices to improve, and almost a straight line this entire week to get to exactly on our target. Now, can we break above this? Where's the next step? Hold on, we'll tell you in just a minute. We're already at some of the best pricing levels of the year, but I think there's a very good chance that things could get better. Let's take a look why. You might recall the 10-year Treasury note. We talked about this and we said, hey, we had a target last week right here in this 220 range, and sure enough, we broke out of this. We said this was kind of like a spring being wound tight. We thought we'd break to the downside. Sure enough, we did. And look at this. We not only hit 220, but we've exceeded it down to 217 on the 10-year. And we said if we can break beneath here, it looks to us that we're going to go right to this 2.02 or 2% range. I still think we are set on a path that looks like we're going to get right to this 2% level on the 10-year. That's going to mean exceptionally low rates. They're already great. And what you really need to do now is position yourself and your customers to take advantage of this, both on the refinance side and on the purchase side, because in the past, as you can see, these opportunities can erode quickly. They present themselves, and then they can disappear. Now, a lot of this is going to have to do with the direction of the stock market. Stocks are, so to speak, cresting here at these levels. It looks like stocks are ready to take a breather, and I think that if we get a little bit of help by the stock market, and I think stocks can move down towards this 2015 from their current levels around 2067 on the S&P. So a pretty significant drop in S&P prices. I think if we get that, we will see a nice improvement. We'll see 10-year treasuries down to 2. Now, as I mentioned earlier, it's both jobs numbers that we'll see throughout this week that will be the catalyst that will influence the direction. Any kind of weakness in the jobs market will be a good excuse for stock investors to take some chips off the table after a tremendous amount of gains. There's already some indecisiveness there. So this will just influence them to say, hey, let's sit on the sidelines. Let's let the market correct itself. Let's not be the last one holding the bag. And that money should flow into the bond market. And I think we're going to see that 10-year Treasury note down to 2%. You might recall our title a couple of weeks ago, are you ready for the next move down? We are right now in the midst of that move, and I think it can get better. All right, get your free trial. Get this information every day, especially with the jobs numbers coming out. You don't want to miss it. You don't want to miss how to position yourself ahead of it and how to explain this to your customers. We appreciate you tuning in. Have a wonderful day. Bye-bye.
Think you can use updates like this every day? Mortgage News Network viewers can get it free every day by visiting mbshighway.com/MNN. Master the Markets airs every Monday at 11 a.m. Eastern Time and can be viewed on mortgagenewsnetwork.com.
This is Mortgage News Network.